there is one FDIC report, their numbers are definitely underestimated. They didn't look at the liability side. I think in order to really understand the key issues of the current banking crisis, we need to understand the liability side. And those uninsured deposits are actually runnable.
They seem to have a huge industry problem, which is they take deposits from an industry that is also very correlated with the interest rate cycle.
They cannot provide explicit guarantee on all of the uninsured deposits because it's a large amount. And at the end, if you ask what would happen, I mean, the government needs to rely on other banks to take over, like what happened to the First Citizen Bank and SVB.
Hi, everyone. This is Randy Xu with Luohan Academy. And we're very fortunate here today to have with us Professor Erica Jiang. Erica is an assistant professor of finance and business economics at USC Marshall. And Erica's research has focused on financial intermediation, household finances, and financial regulation. So Erica has been very busy recently because she, along with 3 co-authors, who are all very renowned academics in this field, have just written a paper entitled Monetary Tightening and U.S. Bank Fragility in 2023, Mark-to-Market Losses and Uninsured Depositor Runs. So obviously this is a very, very timely kind of paper. So maybe I can begin, Erica, by asking you to introduce yourself and your career in academia up to now and what got you into this research.
Great, thanks for having me here. You gave a pretty comprehensive introduction already. So I joined the University of Southern California in 2020. That's actually right before the pandemic. My job market paper was working on financing competitors, and I looked at shadow banks' cost of financing. And so I was very interested in this banking IO questions and also bank capital structure questions since PhD programs. And so our team actually already had a working paper on related topics, which was titled Banking Without Deposits, Evidence from Shadow Bank Call Reports. And so we released that paper before the pandemic, and then people's attention got distracted because of pandemic, and so we all work on some other questions related to government forbearance during the pandemic. And then we had this SVB bank run a couple of weeks ago, and then we realized that is the right time to resume the previous study. And so the previous paper helped us draw some insights about the current bank runs, and so we started to work on this SVB bank run. And so the new research node you just talked about was actually a sort of follow-up paper on the previous paper. So we already collected all of the bank call reports, and then we had some insights about bank capital structure and also especially uninsured deposits. So that helped us think about how exactly we can put together this new piece of work quickly.
Okay, wow. So how long did this all take to kind of refresh and update?
For this new node, I still remember SVB was taken over by the FDIC on that Thursday or Friday, depending on the time zone. And then we had a phone call right after that, and we chat about what exactly we could do. And so we put together this notes over that weekend. So
okay,
the research node was posted on Monday, March the 13th.
Okay, and now it was heard around the world. I see you've been written up by almost every kind of major publication out there.
Yeah, we got a lot of media attention, but what's really helpful for us, or what really made us feel this is really relevant, was a lot of regulators actually reached out. And so we have been told that our research is actually pretty helpful for regulators and also policymakers, because I don't know how this bank crisis is going to last, but definitely the conversation, the regulatory conversations will continue, and people will wonder how exactly we should regulate the banking sector and whether we should insure all deposits. And all of those questions are pretty related to what we have been working on. Yeah.
Okay. So let me ask there, if regulators are interested, because reading kind of through the paper, I was thinking to myself, this should be something that I would expect some regulator, whether it's the Fed, the FDIC, or other regulatory bodies, would have, some tracking or research or system within themselves to, have a rough back of the envelope, even a very rough calculation of the state of things at the banks that they're regulating. Do they not?
So there are a few things we have been tracking and have been talking to people about. I think there is one FDIC report that is the only report they have put out there. In their report, they analyze all the trading securities. And so just briefly talk about what we did, and then I can link to what they did and what we add to their study. We know that after the first quarter of 2022, we had a Federal Reserve monetary tightening, and there were a lot of interest rate increases a couple of times. And then since banks have a lot of long-term assets, including both securities and loans, if you mark to market those assets, then there will be a lot of market value losses. And so that's part of what we did. We look at the entire balance sheet of all the FDIC insured financial institutions, and we mark to market their available for sale securities, held to maturity securities, available for sale loans, and also held to maturity loans. And so that's pretty much 80% of all banks' assets. And then FDIC had a report, and in their report, they mark to market all securities. But we know that loans are actually a much bigger portion of banks' balance sheets. And so if you compare our numbers and their numbers are definitely underestimates. And more importantly, we show in this report that what's really important will be the liability structure. So the FDIC only did the mark-to-market losses calculation on a small portion of the asset side. They didn't look at the liability side. I think in order to really understand the key issues of the current banking crisis, we need to understand the liability side. So we look at how much of their deposits are uninsured. Those uninsured deposits are actually runnable. And so we did different scenario analysis. There are also previous literature that talk about how sleepy those depositors are. And so if those depositors are pretty sleepy, what would be the situation? And if half of the depositors run, what would be the situation? So we did a lot of analysis in this paper. I think that's something that the FDIC didn't have before. I can keep talking. And so, for example, you also mentioned that there are a lot of Federal Reserve regulators, like the different regional Feds and also the Fed board. So they have been doing stress testing. I think that's probably something you had in mind when you mentioned that the regulators should have already known some of the facts we document in this paper. They actually disclosed what they did in the stress testing, and apparently they focused primarily on reduction in interest rates. And also for some of the scenarios, they tested if there is an increasing interest rate, they only cap the interest rate at 4%, and now we know the interest rate is definitely higher than 4%. And so given the fact that we have been reached out by different regulators since we posted this paper, and we're pretty sure we did a pretty decent job, and some of them actually talked to us just to get a better sense about different type of estimates. And so in short, that's what they have been doing, and that's what we did, and that's how I think our work compares to what they knew before our work, and yeah.
Sure. I think what you're referring to is the report they published. I think they had the round roughly $600 billion number in mark-to-market losses, and I believe they were timing that to the end of 2022. So I am still a little surprised that they don't even, they don't keep some kind of estimate, even like a very rough one of the total kind of loan book. And my understanding from your paper is that what you're looking at comprises around, 3/4, like 72% of the assets on the bank's balance sheets, right?
Yeah.
Okay. And so I guess, a question that I had looking at all of this is the liability structure of SVB obviously is very, very, I think you said it's 1%, it's 99 percentile, right?
Yep, if you look at their uninsured deposits.
The uninsured deposits.
Yep.
And so the way, when I talked to Zingales, I felt like one thing that struck out at me is perhaps behind all of this. I think your paper, you said, well, it's perhaps surprising that their asset side is not as impaired, compared to the whole universe of banks. It's somewhere, it's impaired, but it's not the worst.
Yeah.
And I guess my view on this was that that's to the point you make, that's probably not the issue. The issue is that SVB and the crypto banks, particularly Signature and Silvergate, right?
Yeah.
They seem to have a huge industry problem, which is they take deposits from an industry that is also very correlated with the interest rate cycle. Interest rates are low and crypto prices are high. The industry is booming. Interest rates are low and Silicon Valley startups are raising money, hand over fist, right? And then they put it into a bank and they happen to know this bank. So many of them put it into this bank and this bank doesn't know what to do with it. So they put it into which are credit safe securities, right? They have no credit risk. So it seems to me that the underlying problem behind both issues of where they put their money and where they got their money is the fact that they were serving industries that were part of this bubble, right?
Right. So that's why we want to emphasize the importance of looking at the liability structure, how much uninsured deposit they're funded with, and actually, if we look into the data, that's something we document in the previous paper that mentioned banking without deposits. We found actually a lot of big banks rely heavily on uninsured deposits. And so if you classify SVB as one of the big banks, definitely they're not as big as Bank of America or Chase. They're still pretty big. And actually there are many other big banks like SVB in this economy that are heavily funded with uninsured deposits. And so just a brief background about that paper, we look at the importance of deposit insurance. And we compare traditional banks with those bank-like non-bank financial institutions. And so we call them shadow banks, and we look at their capital structure. So if we compare those banks and non-banks across the size distribution, if we focus on the big players, and they actually have very similar capital structure, and so they're poorly capitalized, or they're less capitalized, and most of them have 10% of their asset being financed by equity. And those small players are actually very well capitalized. So if you look at shadow banks, small shadow banks, they tend to have up to like 40 or 50 capital ratio, like equity to asset ratio. But those small banks actually still have about 10% to 15% equity to capital ratio. So what that means is those small players actually benefited a lot from deposit insurance. They wouldn't be able to raise that much deposit if there was no deposit insurance. And so I guess I'm not sure if that's consistent with your prior, that many small regional banks rely heavily on uninsured deposits. Actually, it's not just those small banks. There are many large banks in the United States that heavily rely on uninsured deposits. And so all of those uninsured deposits are runnable.
Okay. Right. So if you were to kind of think of solutions to this, let's start with what's kind of happened in the last week or the last 2 weeks. What do you think of the solution that's been implemented so far, where you seem to have, first of all, coverage of the banks that failed and their depositors, and then this Fed facility, as well as very, very strong language from the authority. They want to prevent systemic risk, but without an explicit kind of guarantee.
Because they can't. We did a calculation. We did a calculation about how much the government needs to spend if they want to cover all of the uninsured deposits. That's beyond, definitely beyond the FDIC deposit insurance. And if you compare that to the government balance sheet, it's just a large number. They cannot provide explicit guarantee on all of the uninsured deposits because it's a large amount. And at the end, if you ask what would happen, I mean, the government needs to rely on other banks to take over, like what happened to the First Citizen Bank and SVB, and also actually, this is not the first time, right? If you look at the financial crisis, there are a lot of banks failed. The government itself will not be able to take over all of those assets. And so eventually they facilitated all of the merger and acquisitions. And so two of my co-authors had a previous paper about selling failed banks. And so they look at how exactly those banks could be taken over by other banks and how much discount they would receive if they will not be able to sell their assets to other banks that can best use their assets. You know, like if, especially during a crisis, all banks may have some equity losses. And if the bank, the healthy bank that can best use their assets are actually undercapitalized and will not be able to acquire, for example, SVB, then the asset will be sold at discount. And that's actually what happened, right? First Citizen acquired SVB, but the assets was sold at a huge discount, about 25% discount.
Okay. But it seems like that is also very costly.
Yeah,
well.
that is costly. Yeah.
So it seems like because banking being something of a confidence game, and bank runs being this self-fulfilling loss of confidence, obviously in the short run, it seems like it makes sense for the government to be very strong and try to the extent that they can legally, right, try to give a sense of confidence. But I feel like I wonder if one of the issues that Nindala's pointed out in our talk was that we have this situation now where people can run. They can run for many reasons, right? With SVB, they happened to run the last day because everyone else was, and you don't want to be last. But you might run because of better interest rates, right? We live in a zero interest rate environment. It doesn't really matter if it's 0.2 or 0.3, right? Now maybe you have choices. So I think his point is that what the regulators hope for is that financial repression continues, and then you have banks that pay low deposit rates, and that will over time fix the problem. But if you can't guarantee that, that then you still have a problem. The ironic thing, of course, is that if you're a big bank right now that's systemic, you potentially are getting deposits in, and you may not have to pay that much in deposits. Like I think in your paper, you said that those banks were probably have the least problem right now. They had a 4.4% impairment, from par. But those banks are probably the ones they attract deposits. They don't actually have to pay a high rate to attract those deposits because people are just fleeing to safety.
Well, I think you touched up on a few points on what regulators can do going forward, and is this an issue about distribution, small versus big? I think at the beginning you were talking about the sunspot argument, like why do we all of a sudden shift from one equilibrium to the other equilibrium? Why the depositors start running? I think the question is ultimately ex ante what regulators can do, and definitely two things are being discussed nowadays. One is whether we should insure all deposits going forward, right? And so previously we had this deposit insurance limit, which is capped at $250,000. Should we just provide deposit insurance to all deposits? And if we do, the question is whether we should strengthen either the capital requirement or just expand the set of banks that are being stress tested. I think definitely if you're going to cover all of the deposits, there wouldn't be any runnable deposits anymore, right? We wouldn't have any insured deposits anymore. But there are a lot of more hazard issues and also issues about cost of funding especially for those small banks. But so if you do that, then the question is about how much capital requirement you should impose. And so in our previous paper, we actually look at this by looking at bank-like financial institutions, right? So for those financial institutions, they will still be able to do those lending activity with only 24% of equity, with as high as 24% equity rather than 10% equity. And so I think all of those are actually questions that we need to discuss. Right? It's not like, given that we are already in the spot, like how we can move from one equilibrium to the other equilibrium. We know that there will always be chance to get into those bank-run situations, right? Like the situations you described, interest rates and all of those, and maybe just all of a sudden the market lose their confidence. The question is always ex ante what you can do to prevent or to lower the chance of those bank-run scenarios. And so Gregor Mel, also one of my co-authors on this paper, had a previous AER paper on competition, like competing for deposits. And so there specifically to look at how much capital requirement the regulator needs to set in order to lower the chance of bank run. Right? So like we are all economists, we know that we need to lower the probability rather than removing the probability from bank run. That's just by nature of the bank's business model.
Okay. Well, in the popular press, so I'm not someone who's kind of looked at banks all my life, but in the popular press, it seems like people are saying that what's been going on might be horrible going forward for small and community banks, right? Mm-hmm. Like if you fear the safety of your money, you want to put in a systemic institution. Do you think this is a fair worry to have? And do you think this is something we as a society need to decide? Because I think the rhetoric that everyone says is we especially every politician will talk about the small community banks and their state. And there's research that shows, small community banks tend to give more local loans and potentially for small businesses. Is this potentially something that we as a society, need to make a trade-off of potentially we need to do things to help them?
That's a very good question. The question is, what is the counterfactual you have in mind? Meaning that, when you say those small banks will get hurt, what is the benchmark? Again, sorry, I need to refer to some numbers, some statistics we document in the previous paper. We show that without deposit insurance, there wouldn't be that many small banks to begin with. And so in some sense, the society or the government has already been helping those small banks to exist in the first place. And that's definitely true because we know there are a lot of benefits of having small banks in the local community, right? And big banks may not do a lot of relationship lending. They may not provide enough lending loans to small businesses. And definitely that's something that small regional banks are doing. And they are benefiting from the existence of deposit insurance, right? So in the previous paper, we look at those non-bank financial institutions, and especially for those small players, they wouldn't be able to have that much debt ratio. So if we look at their capital ratio, they have to have up to 40% of equity to run their business. And if you look at those small banks in the United States, they still have pretty low equity ratio, probably slightly higher than those big banks. But so we attribute that difference in equity ratio to the existence of deposit insurance. So small banks actually benefited a lot from deposit insurance, right? So from your perspective, you are just a regular depositors, you will not have confidence, like even without all of those bank run issues, right? You would not have confidence to deposit your money at a small regional banks if it was not covered by deposit insurance.
Okay, understood. That's a great point. So maybe the last couple of questions I have, since we're a digital economy research organization, it seems like the type of work you did, which is very, very useful, and again has been cited all over, and now it's no surprise that regulators are talking to you guys. It seems like with all the technology that we have today, and obviously recently we've been talking about generative AI technologies, but there are other forms of much simpler AI technologies we've been working on for some time. It seems like there's a lot of technology we probably should deploy to this problem, right?
The question is actually the Fed already received many data. So if you look at how much data they collected from those big banks.
But my question is
Yeah.
like, why don't we have systems that
Yeah.
are much more easily in an automated fashion, take
Yes.
all this data and try to, run with it? Why do we have to limit ourselves to this test, the stress test at what date? It seems like nowadays we should be able to solve this
That's
problem.
definitely a very good question. I think on both sides, technology can help. Bank side, if they're able to streamline all of the data collection process, and that will lower their regulatory compliance cost, and that can definitely help banks comply with all of the regulations. And on the regulator side, if they have better technology, I don't think they don't have those technology, right? And so they actually already automated some of the stress testing for those banks that are not passing the systemically important threshold. And so for banks that are below 250 billion, but they're still pretty large, they actually provide, some regional feds actually provided some algorithm those banks can self-stress test it. And so they provide the algorithm, they tell them, oh, those are the models we use, and given all of those scenarios, how much your bank is able to deal with those risks. The question is, what are some sensible scenarios they do? Maybe people can have a much more reasonable scenario tests. I don't know. I think technology can definitely help, but I still don't see why they didn't do those by now. Like, they already had all of those technologies before, right? We have all of the, they have data, they have models, and I don't think training a model is a pretty sophisticated, it's a pretty complicated thing. Some of my Fed co-authors are actually working on, so whenever they do stress testing, I think the primary goal is to improve those models from time to time. They look at how much they underperform and how much they hit, and then they improve those models. And so maybe I think that is where AI or machine learning can help improve.
Okay, great. Well, appreciate those insights, and thank you for your useful work, which hopefully will help to kind of make our system much safer. So certainly appreciate this work and all the future work that I'm sure you guys will do in this realm.
Yeah, I mean, it's always been my goal to make some impactful research that can help the society.
Great, and then thank you so much for coming
Thank you.
and sharing these insights with us.
Yeah, thank you.